Hey, thanks for stopping by. My name is Dave Freitag. I am the Wall Street Cowboy. Thank you for taking time out of your busy schedule to watch one of our videos. Today, we're going to talk about basic strategy 1 week bull put. This is a presentation I did for the OTFI group, which is a Skype group. You are free to join. And I did for another website. That's a picture of me and my current trading station. That's where I report to every day to start the trading day. If you like our videos, remember, hit that subscribe button and the like button. We can sure use your help. First of all, before I get started, I definitely want to go over the different disclosures that are required. Remember that this is for educational and informational purposes only. Nothing here should be construed as a suggestion or a solicitation to buy or sell securities. Investing is risky. You can lose all or a part of your money. None of the information here has been verified by a third party. It is hypothetical in nature. So before you invest, do all of your research. Okay, this trade is okay for people who have an intermediate to an advanced level of trading. If you're brand new to trading, you may not understand some of the concepts such as options and option theory. There's a number of places where you can get educated on options and how they work and how Greeks and all that good stuff works. So educate yourself on that, and this will make more sense to you. You must have the privilege to write option spreads or verticals in your account, or this will be meaningless to you. So if you don't know what that is yet, do some education, reach out to your broker dealer and see if you can get options added to your account. The minimum size on this is, I'm suggesting at $2,500. You really don't need that big of an account. You could have a very, very small account, a few $100s, and you can start doing this trade. I do recommend that you start with something about $2,500 so that you have plenty of room to withstand some of the fluctuation in the market. Okay. The little bit of about me, I'm from Las Vegas. I live in Las Vegas now. Back in 1987, in fact, October 19th, which was in fact Black Monday. That was the worst stock market crash in history. That was the day I became a stockbroker. I took my test on a Saturday. I came to work on a Monday to smile and dial and be a cold call cowboy. And boy, I felt the whole market melting around me. But talk about starting at the bottom. That was the best place to start my career. In about 2015, I became a professional options trader. I started trading for all or portion of my income. I currently admin a Skype room. You are welcome to join as long as you bring content that is related to trading. If you are looking for a political floor to voice your opinions or political views, this probably isn't the best group for you. This is all about trading. Now, there are some issues that you can share that might help with trading that may be related to some political issue, as long as that's not your agenda. I do have this YouTube channel where you can get free content on different trading. At one time, I was a private advisor for friends and family, where I used many of the trades I share on this YouTube channel for those clients. I would make decisions on their behalf. These are people that I knew personally or are members of my family. So what is this 1 week vertical trade strategy? Well, you enter a bull put, which is a bullish vertical strategy that is done at a credit. Again, if that's new to you, there's plenty of places where you can get educated on what a bull put is. So from this point on, I will assume you understand what a bull put is. You enter a bull put on the first trading day of the week. Now that's mostly Mondays, but every once in a while we have a Monday holiday. So Tuesday is the first day of the week. There's a slight modification when that is the case, but we'll get into that in a little bit. But first day of the week, you put on a bull put and then you go and play golf. That is the trade. It's very, very simple. Anybody can do it. You don't need some special Houdini indicator, phase of the moon thing to get into this trade or know a lot about trading or anything else, you can put this trade on and go about your day at work or at play, whatever you want to do. I'm going to talk to you a little bit about a gentleman by the name of Mark Douglas. He wrote a book called Trading in the Zone. He also has some YouTubes out there that are sessions and webinars that he did, I think mostly here in Las Vegas, but they could have been elsewhere. But he explains to you a concept of how to trade your account. One of the experiments that he talks about is putting on the exact same trade 20 times in a row. Now, this means that you set parameters, and if those parameters are there, you put the trade on. You don't care what's happening in the market. You don't care if it's a Friday or a Monday, if there's going to be an economic report come out, or if the president is being elected today. You don't care about any of that stuff. If the conditions are right, then you put the trade on. Now, what he suggests is that, let's say you had an account of $200,000 and you were willing to lose 2,000 of that 200,000. That at that point you cry uncle and say, I'm all done. I'm going to put all my money in CDs. All right, that's fine. Whatever that amount is, $2,000 in this case, you want to break that up into 20 trades. So you're going to risk $100 in each trade. $100 times 20 trades, $2,000. If you lost every one of those trades, 20 in a row, you were 0 for 20, then the most you would lose is $2,000. That's the experiment. Now, nobody expects that you would lose 20 trades in a row. So you should have some money left over no matter what. But in the worst case scenario, you lost 20 in a row, you would still have $2,000. Now, you are going to hold that trade for either a max gain or a max loss. That's it. You're not going to monkey with it. You're not going to adjust it. You're not going to change it. You're not going to try to improve it. All you're going to do is put that trade on and forget about it. You either make money or you lose money 20 times in a row. If, in fact, the trading strategy you are using has edge or a propensity to win or have a profitable outcome, then at the end of those 20 trades, you're going to have more than $2,000. If you do not have more than $2,000, then your work continues. You are still in search of edge. So until you have edge, you should not be trading in the market. Now, there's all kinds of edge. I'm going to show you a couple of different ways that you can get edge today. So we'll get into that in just a little bit. So determine if you have edge. Execute 20 trades in a row perfectly if you have a better than 50% win-loss record. In other words, you put on 20 trades, you won 10 and you lost 10. That's 50-50. As long as you have better than that and your risk reward is 1-to-1. In other words, you are risking $1 to make $1. You're risking $100 to make 100. You're risking 500 to make 500. That's a 1-to-1 risk reward. If in fact you have a 50% win-loss record, then you have edge. If you cannot do at least 50%, there's no way you're going to make money in this market. Now, you could have a 30% win-loss record. You could win 3 out of 10 trades, but you better have a reward of $7 for every $3 you're at risk. Then you can be profitable, and then you do have edge. If you are like most people, it's the reverse. You are risking $3, or you're risking $7 to make $3, and you only win three out of 10 trades. Those 3 trades are magical. You think you're a genius, but the next 7 trades, you lose all of the money you made in those 3 winners, and then part of your portfolio. That's where most people are. We're going to try and show you how to avoid being that person. All right. So what's the trade? Pretty simple. You're going to enter an ATM. That stands for at the money. In other words, if the price of the security you're investing in is $100, then you're going to use an option that is also at $100. You're not going to use the $50 strike. You're not going to use the $80 strike. You're going to use a strike that is at the money. In other words, the same price as the underlying or the security that you're trading. We're going to talk a lot about the SPY today. So an at the money bull put on the SPY assumes that if the SPY is trading at $400, you're going to put your bull put at $400 or slightly higher than that, maybe 401, maybe 402, but it's going to be pretty close to being at the money because that's the price that the SPY is at the time, at the money. And you're going to do that the first trading day of the week. If you can understand that line right there, you've got 90% of this strategy worked out. You're going to use the expiration for the following week. So if I'm going to open this trade on a Monday, that's the open Monday, then I'm going to allow the trade to expire the following Monday at the close. So that's a 7-day trade. Open it on Monday, it closes the following Monday. You're going to do it at the open this week. You're going to allow it to run all the way to the close next Monday. Now, the entry is based on the opening print of the day. No, it doesn't matter what the moving average is, the MACD, the Bollinger Band, doesn't matter what any of that stuff is. You're going to look at the opening print of the day. There's only one. It's a static number. So if the opening print, the opening price on Monday was $400, that's what it will be forever and ever and ever. It will never, ever change. It is that number and it's static. So whatever that number is, that's what determines where you're going to put your bull put. It does not depend on some crossover or some special indicator or phase of the moon that says, well, when this moves in this direction and that moves in the opposite direction, that's when you enter the trade. No. Whatever the opening print is, that's all you need to know. And then you're going to place your trade. There are no adjustments to this trade. You do not have to sit here and watch this trade over and over and over. You just place the trade and forget about it. Now, some of you may know me personally, or you've heard my presentations in the past. About a year ago, I had a very, very minor stroke. I needed to step away from the market. I needed something, a trade, that I didn't have to watch every tick of the market. This trade is perfect. I can put it on, look at the market for 5 minutes, and then go play golf if I want to. I do not have to sit there and glue myself to the screen all day long. So for those of you that work or go to school or have other commitments during the day, you can do this trade. You're not going to blow up your account. In fact, you're going to grow your account over time. I'm going to show you how that's done. And you can forget about it. You don't have to stress over this trade all day long and worry about every move up and move down in the market. The desired risk in this, the risk reward is 1-to-1. We talked about that. If you're going to risk $50, you want to be able to make $50. So the max gain $50. I'm not going to figure in commissions and fees and things like that. That's just the cost of doing business. But I am looking at the actual profitability of the trade absent any commissions or fees. So everybody's got different commissions. No, we're not all, painted with the same broad brush. Okay. If you want to have more money than $50, that's fine. Just do more bull puts, add more contracts, do 2, do 4, do 10, do 20. But you're going to risk $50 for each one of these bull puts. It's a 1 contract bull put. You're going to sell one and you're going to buy one. If you want more money, just do more. Easy. Now, those of you that are more visually aware and can see things visually better than you can numerically, this is a picture from a platform called Thinkorswim, affectionately called TOS or TOS. This is what a bull put looks like. So there is the price right here, which at that moment, the price was at $467.94. This trade, this blue line represents your total risk. The top of this blue line represents your total reward, and this middle line shows a 0. So anything above that is a win, anything below it is a loss. What this is a $1 wide. You can see this is 468. I am positive 1, and the 469, $1 higher than this, I am negative 1. So this trade is $1 wide. Now I'm going to collect a credit. In other words, I'm going to get more money for this one that I sold than I am going to pay for the one that I bought. In this case, 46 cents difference. That credit is yours to keep forever. Nobody can ever take it away from you. Nobody can ever make you give it back. That is your money to keep. So if my entire risk is $1, that's the difference between 468 and 469, but I brought in a 46 cents that I never ever have to give back, then I have brought in 50 cents of this $1 move. Okay, so I have $46 of reward and the difference between $1 and 46 or 54 cents of risk, approximately a 1-to-1 risk reward. It's not always the case that you're going to get exactly 50 cents, because 50 cents of a $1 wide spread would be exactly 1-to-1. I would bring in 50 cents for a $1 risk. So I'm risking $1 or risking 50 cents to make 50 cents. That would be a true 1-to-1. This is acceptable where you have slightly less than 1-to-1, but you want to be pretty close. I wouldn't get too much further away than 46 cents, 47 cents, 48 cents, 49 cents. And basically what I'm going to do is I'm going to put this trade out there at 46 cents and then just walk away. I'm going to let the price action of the day fill that trade for me. I'm not going to sit there and move it around and try and be magical about it. Now, if you put this trade on and it doesn't get filled because price action isn't favorable for you to get filled on that right away, then I could see you moving this up from 469 to 470 and from 468 to 469. So in other words, still $1, but try to get 50 cents, right around 50 cents, maybe 49, 48 cents. I can see you doing that, but that's as much of a modification as you will have to do. You're not going to chase this all day long. You're going to put it on and you're going to forget about it. Okay. So everything in this trade is about math. There is no special Houdini thing that you got to figure out. It's math. It either works or it doesn't. Everything that we're using is based on the OHLC, the open, the high, the low, and the close price of the day for the SPY. And I went all the way back to October of 2009 to gather this information, and I put that into an Excel spreadsheet. So again, there's no smoke and mirrors here. It's Excel. Excel either is or isn't. And what I'm looking at is what was the price on the open on Monday? What was the price on the close the following Monday? Is one higher than the other? End of calculation. Excel does that. You don't have to put any special conditions or anything or do anything special. It either is or it isn't. In other words, it's math. If the math adds up, then it works. If the math doesn't, it doesn't. Okay, I use interactive brokers. I don't prefer them. I don't recommend them. They're a tough broker to work with, but they have very low commissions. You can use Thinkorswim, you can use TradeStation, you can use whatever you want as long as you are able to do option strategies that you write, which are very basic. They're called spreads. Talk to your broker dealer, make sure that you have that privilege on your account. Now we can use strategies. We're going to talk about strategies within Thinkorswim or TOS for analysis. We'll get into that towards the end of the presentation. Why does this trade work? It works because of what's known as positive drift. In other words, the market tends to go up over time. And if you look at any kind of a chart, you can see that with the SPY, and when I'm looking at, when I say any kind of a chart, I'm talking about something that is better than a week. You know, you look at a 1 year, 2 year, 5 year, 10 year, 20, 30, I don't care what it is, but longer term chart, it typically goes up and then it has a pullback and then it goes up higher and then it pulls back. And this is just a typical looking 1 year, 5 year, 10 year chart. And we call this a chart that goes from bottom left to top right. That's the kind of chart we're looking for. And the SPY is that kind of chart or that kind of security. That is positive drift. Over time, or with the drift of time, we go in a positive direction. That's all positive drift is. And if you were to really look at it, it simply is what we call buy and hold. That's all that this is. The key in this is risk reward. If you have a 50% or better, and really it should be better than 50%. If you have better than a 50% win-loss record, in other words, I put on 20 trades, 11 of them were wins, 9 of them were losses, that is a better than 50-50 win-loss record. If you can do that, and your risk reward is 1-to-1, there's no way you can come out at the end of a reasonable sampling of trades. You know, you look at 2 or 3, maybe not. You look at 20 or 50 or 100. Yes, you will see that at the end of those trades done exactly the same way every time with a 1-to-1 risk reward, there's no way you can come out mathematically without a win. This trade optimizes that edge, but you got to have discipline. You have to be resolute. You got to be able to stick with this trade. You can't get worried that the trade is losing money and that you may lose your entire $50. That's part of trading. That's discipline. You must sit through these trades. There are going to be losing trades, even if I'm right 51 out of 100 times, that means 49 times I will have lost. That is trading. When you get over that, you will become a better trader. If you have special technical analysis that you really like or opinions about the markets, use that on your other trades. This one does not rely on having good technical analysis. You really don't care. Okay, so let's move forward. Oh, I know what's going on. There we go. This will help. Now, this is what my account looked like a couple of weeks back with Interactive Brokers. These were live trades. They have since closed and they were all winners. This is the put side. This is the call side. Okay, so I had 2 bull puts, and I had them $1 wide. That's exactly what we're looking at. Over here, I did do one on the call side, and we're going to talk about how and when and why we do something on the call side. But then again, it is the same thing. These are $1 wide, 460 by 461, $1 wide. But in this case, I sold these for $1.84, and I bought these at $2.37. That means I paid 50 cents. So this is a debit. This side is a credit. I paid 50 cents. Now, what I'm hoping is that these would go all the way up to $1 and I'd be able to sell them and collect that $1. So I paid 50 cents. I got paid $1, so I made $50 on that trade. What's the most I could lose? The whole 50 cents I spent, or $50. So my risk is the same. Risk reward is identical. Now we're going to talk about why this is not 50 cents difference between here. Some of you have already seen that and said, hey, Dave, that's not 50 cents. This is closer to 50 cents difference, but this isn't. We're going to talk about how that happened. Okay. So the preferred security in this is the SPY, the SPY. You can use other securities, but for right now, just focus on the SPY. We'll talk about others in a little bit. Monday morning, first trading day of the week. Now, if Monday is not the first trading day of the week because it's a holiday, then just do this on Tuesday. No big deal. There's going to be a slight change, but it's easy to understand. But if you get this down, this is it. This is the whole trade. Monday morning, first trading day of the week. Last couple weeks back, when the trade that you just saw with Interactive Brokers, the SPY opened at $460.30. Okay, so how do we put on a bull put? We're going to look for the first in the money put strike. So if 461 is above, higher than 460.30, that means it's in the money by the difference between this 461, this 460.30. So it was 70 cents in the money. So that's the one we're going to sell. That's the first thing. Easy peasy. Next, try to avoid the 50-cent strikes. In other words, you could conceivably see a strike that says 461.50. Don't use those. And I'm going to tell you why. They aren't always a complement on the next dollar. In other words, you might have the 461.50, but you might not have the 460.50. So now you don't have $1 wide. Maybe it's $1.50 wide. That just confuses the whole thing, because now you got to think about what's 50% or 1-to-1 risk reward. It's a little bit more work for you. Just avoid those 50-cent increments. A lot of times you'll see them at the $2.50 and $7.50 levels. In other words, 462.50, 467.50. A lot of times you'll see them there. Just avoid those. Just try and stay with the whole dollars. If there is no alternative, then there is no alternative. But if you can stay away from them, I would. Okay, so I'm going to sell the 461, and then I'm going to buy the first out of the money. Out of the money means that this has no intrinsic value. The price of the underlying is above that put price, so it really has no intrinsic or true value. It's all based on probabilities. It's got 30 cents before this one would go in the money. So I'm basically straddling the at the money. This is the at the money price. I'm basically straddling that. Again, I mentioned earlier, you might have to move this up from 461 to 462 and this from 460 to 461 in order to get your 1-to-1 risk reward. Don't worry about that. That's just fine. Go ahead and do it. You just want your risk reward to be 1-to-1, and you want to be as close to being at the money as possible. There might be a little bit of give and take there as far as whether it's $1.50 in the money, or whether you get 50 cents or 47 cents. There's a little bit of massaging in there. You want to get those as close to the ideal as possible. So straddle this. One is out of the money, one is in the money, and try to get 50 cents. Use the following Monday's expiration. In this case, the 8th. So I put the trade on the 1st. 7 days later, it will expire and run out of life. And that will be when the strikes, these 461 and 460s, will expire. Okay, let's see here. I simply set it good to cancel. In other words, I just put the order out there and walk away. And I do put a good to cancel in case it doesn't get filled today. Maybe it gets filled tomorrow. That's okay, or try not to do that. But I do put this out there and just walk away. I don't chase it. I did talk about moving the price up maybe $1. All right, I get that. Don't be moving this up $1 and then another dollar and then another dollar, or down $1 and down another dollar, down another dollar, because the market action is moving away or for you. Just put it out there and forget about it. Let the price come to you. It will most of the time. Just because the market breaks to the upside first 10 minutes of the day doesn't mean it won't finish the day lower, and vice versa. Just because it breaks out to the downside the beginning of the day doesn't mean it won't finish the day higher. Price gyrates and fluctuates all day long. And as that price hits, it moves up and down, that 50 cents becomes more and more in play, or less and less in play. It's not going to be that much different. It's not going to go from 47 cents of credit down to 37 cents of credit unless the market is really, taking off in one direction or the other. It's going to stay within a penny or two of what you put it out there for in the morning right after the open. And eventually it does fill. All right. If you don't get in today for whatever reason, you can always go in tomorrow. In other words, Tuesday. So keep in mind, we're doing a 7-day trade. There is no Tuesday expiration trade. So I wouldn't use Monday. In fact, I suggest you don't use Monday's expiration if your first trade of the day or first trade of the week is on a Tuesday because you missed Monday entirely. Go out, the next expiration is Wednesday. Just use that. It makes it an 8-day trade. The reason for that is the more days that you give it, the higher your probability of a win. We're going to talk a little bit about that in just a moment. This could mean using a Wednesday of next week expiration for a Tuesday entry. You probably don't want to use Mondays. All right, so be selective on the security of choice. I would suggest starting with the SPY. Some people will say, well, I like the SPX. Well, that's nice. The problem with the SPX is that the spreads between the bid and ask are really, really, really wide, and you can set your price out there and price can go right through your mark price. In other words, you can see the price of that option going right, it'll go up to better than what you are offering, and it still won't fill you. It's crazy. So I don't use the SPX, and it's because the spreads are too wide. I don't use the IWM or the Russell. The IWM is to the Russell what the SPY is to the SPX. The IWM doesn't perform well, and I'm not sure 100%. There's people that probably could give a better explanation of that. Doesn't matter to me because the SPY is all I need. I don't have to do the IWM, but my guess is that volatility is higher with the IWM, so it doesn't work as well over time as the SPY, but there could be other reasons. Anyhow, for whatever it is, it doesn't matter. The SPY performs better than the IWM on this trade. Other entities that you could look at or securities would be Apple, Microsoft, American Express. They have worked well for me in the past. Securities like Caterpillar, Tesla, and as I mentioned, IWM, and not so much. All right. The total risk on this trade is $50. We talked about that. It's $1 wide. We collect a 50-cent credit. Maximum risk on this is $50 plus commissions. You do not need any special permissions on this account. You don't need to be a day trader. You're not going to enter this trade and get out of it today. At minimum, you're going to hold it overnight, minimum. So you're going to hold this. You don't need to have any special permissions. You do not have to have the ability to write naked puts or what we call uncovered positions. Now, we're going to get to that in just a minute. You don't need any special permissions. As long as you can do options, basic options strategies, and right spreads. That's all you need. Now you can size up to fit your account size. If you would rather risk 150 to make 150, maybe $50 isn't enough for you. That's fine. Make it 3 bull puts instead of 1. All right, you're risking 150 to make 150, or roughly that amount. Okay, this is great for people that are new to options trading. You got a daughter, a son, an aunt, an uncle, a nephew that you want to help learn how to trade. This is a great trade. This is a great trade. They don't have to watch the market all day. They are going to learn that there are losing trades, and that's okay. They're going to make money over time. That's what they want. They do not have to know anything about technical analysis or any of that other gobbledygook. This is a great trade for somebody brand new to trading, or maybe has limited access or time like I did over the last year. Okay. Now, the power in this strategy is in 3 things. First of all, we have historical edge of 60%. Remember, I was talking about a coin flip at 51%, 49% losers. This has 60% of the time you are a winner since October of 2009. And I'm telling you, there's nothing magic about October of 2009. You could go all the way back 50 years if you want. You're going to come up with the same numbers. You really are. It's not going to be any different than 60%. It's going to be the same. You could look at a 1 year, a 2 year, a 5 year. It doesn't matter. It's going to be 60% of the time. All right. And that is verified through Excel. I'll show you that in a minute. Okay. You will add on size to winning campaigns, and you're going to stay small in the ones that are losing or likely to lose. And I'm going to show you that in a few minutes too. Positive drift of the SPY over time is your friend. Even during times of short-term bearish, where we're down for maybe a month or two, no problem. This trade still works. Make 60% winners over time. That's all figured into this. Believe me, it will be a bad time. You will have 4 or 5 losing trades in a row. That's okay, because you're going to have 4 or 5 or 6 or 7 winning trades. So just understand that 60% is that 60%. This trade will have losing campaigns, approximately 4 out of every 10 weeks. So it's a lot of them. You'll get over it. Believe me, you'll see your account going up over time. Now, if you think about it, if I have a historical 50% win-loss record and things don't change significantly, in other words, we don't enter into a complete debacle on the stock market, then over time, we will continue to get approximately a 60% win-loss record. And if we are able to get a 1-to-1 risk reward, you tell me how you can lose money on this over time. Looking at a 20 trade period, a 50 trade period, 100 trade period, you cannot possibly lose money unless you do what I did, which was tinker with the trade. All right. And that's where that difference was on that IB trade that we saw, where it wasn't 50 cents. We're going to get to that. Adding on additional tiers increases risk. Now, tiers isn't contract size. We're going to add on more bull puts on Tuesday, Wednesday, Thursday, Friday, potentially. That's adding on additional tiers. It is going to increase the risk, but it's also going to increase the reward, right? Because it's a 1-to-1 risk reward, whether you do the trade on Monday or Monday and Tuesday, you're still going to be looking for a 1-to-1 risk reward. We're just going to make the trade bigger. Now, I told you I live in Las Vegas, and edge is everything. That's what makes this city. That's why they have these big hotels and pay for headliners and give you all the free drinks. It's because they have edge. There's a game here called blackjack, and there's a strategy that some people play called basic strategy. Even if you played that perfectly, and very few people can, even if you played basic strategy blackjack perfectly, it still results in an edge to the house of a better than 50%. And you know what? The house is happy to have it. All they do is open up more tables. They lower the minimum bet, so more people sit at that table. They keep those going, and they put their fastest dealers at blackjack because they want to get on as many hands as they possibly can. They don't care what the phase of the moon is because they know if they do 1,000 trades, 505 of them are going to be winners. 495 they may lose if everybody was playing perfect basic strategy. The reality is very few people know how to play that basic strategy that well. So that is the worst case scenario. So you think about it. If they can build these hotels with a 50.5 and you have a 60% win-loss, how can you lose money? Okay, so how do we add on additional tiers? On Tuesday, if the opening print of that day, the open, is greater than, well, you can look at one of two things. You can look at the open of Monday or the previous day, or what is the long strike? The long strike is going to be very close to what the open was, right? Because that's the one that's right at the money and usually is closest to the at the money price of the underlying at the time. So you can use either one, but don't flip them back and forth. You know, if you're going to do the open of the previous day, then always do the open of the previous day. Like Mark said, make it 20 trades exactly the same. Don't flip them back and forth. If it's the open, then it's the open. If it's the long strike, it's the long strike. So basically, all you care about is the market going up. Is it going in a bullish direction? Open versus open. That's it. If it is, add on a second bull put. You're going to use the same one-to-one risk reward. So you're going to go whatever strikes will get you a one-to-one risk reward. And you're going to use Monday's expiration if you've already gone on a trade on Monday. Remember, we only use Wednesday if we didn't get a trade on Monday. If Tuesday turned out to be the day that we got our first trade on, then we're going to use Wednesday. But assuming we got Monday's trade on fine, and most times you will, if you're going to add on a tier, that first tier and every tier after this will be done for Monday's expiration. So that Tuesday trade won't be a 7-day trade, it will be a 6-day trade. All right, still going to have pretty good risk reward and win-loss. You watch. Okay, on Wednesday, same thing. If the opening print is greater than Tuesday, we're not going to look back to Monday now. We're only going to look back one day. If the opening print on Wednesday is higher than the opening print on Tuesday or higher than the strike that you did on Tuesday, then add on another bull put. Again, using Monday's expiration. Now, this is a 5-day trade. So the first one was 7, the second one was 6, this one's 5. I think you're seeing where we're going with this. So you're going to add on a third one, again, at the same one-to-one risk reward, and you're going to use Monday's expiration. All right, so pretty simple. If Tuesday's open was not greater than Monday's, then you're not going to add this trade on because the trade isn't working. So you're going to stay small when it's not working. You're going to get bigger when it is working. The same for Wednesday. If Wednesday's higher than Tuesday, then you're going to add on a third. If Thursday's is working, you're going to add on a fourth. And you could get up to 5 of these in 1 week. However, if Tuesday's open is not, if it's not, then don't add on. And if Wednesday's is not, then don't do it on Wednesday. And the same for Thursday and Friday. So you could, in theory, put the Monday trade on, not do one for Tuesday. Yes, you do one on Wednesday because Wednesday's higher than Tuesday, and then up Thursday, the market went back down again. So we don't do one on Thursday, but Friday it went back up. So we do one on Friday, right? I mean, you could have any combination. It doesn't matter. And you're going to see why that is in just a few moments. Okay. What if I want the strike I want to use is already being used? In other words, we saw where we were short that strike, but now we need to be long that particular strike. What do I do? Well, we're going to move that over and do the call side. Remember, you saw that on that IB. We did one on the call side. It's essentially the same trade as the bull put. It's just done at a debit. You're going to buy it for 50 cents with the idea that it's going to go to $1. You're still risking $50 to make $100. There is no difference except that one is done at a credit and goes down to 0. The other one is a debit and it goes up to $1. Same 50-cent move, and it will move identically. One's not going to move different than the other. Okay. However, keep in mind that deep in the money calls that are short run the risk of being assigned or executed. You don't want that if you've never done it before. It really isn't that big a deal. Once you've gone through it, you kind of go, wow, I thought that was going to be a lot more scary than it was. And it really isn't that scary. But just avoid that. Best practice, enter, as soon as you get in, enter a good till cancel order to get out at 98 cents. The most you could make is $1. Put it in at 98 cents. If it hits that, it's going to fill it. Believe me, they fill it. I don't know why they fill a trade like that where there's only 2 cents of potential gain out of it for them, but they do. And I usually get them filled on a Friday. So I don't even have to hold that trade, that particular trade, if I have it on the call side, all the way until Monday's expiration. Many times I'm out by Friday. And again, I don't know why they do it, but they do. That's probably because they just need the inventory, the market makers. Okay, so remember, this is what we saw before. This is the call side. We put it on at 50 cents. This one was supposed to be 50 cents. Now, some of you may be saying, well, Dave, how come this is only like 22 cents? You sold this for $2.56, but you bought these for an average price of $2.37. Well, it's because I broke one of my rules. Don't be Dave. What I tried to do was I tried to go naked right here. I tried to sell one of these and then said, well, over time, the price will move in my favor. This $1.67 will, this 234 or whatever it was, will go all the way down and I'll get better than 50 cents. Don't do that. Don't be Dave. Look, that is sometimes you're going to get lucky and you're going to get a better than 50-cent credit because you legged in. I'm going to tell you, don't do that. You're going to end up like this so many times, you're just going to wish you hadn't. Now, it ended up being a max gainer, but I didn't make $50 on these, did I? Or $50 times 2. I only made $20 times 2. So what was my risk reward? My risk reward was 80 cents to 20 cents. Now, I ended up making the money on it, but I did not make what I could have made because I messed up my risk reward. Don't leg in. You can do the call side if you need to. Just put that order out there for 50 cents, buy it for 50 cents, and then do a good till cancel to exit. So, all right. Trades that are working, you should get larger in. I'm going to show you that next. Trades that are not working or show signs that they're not going to work, you want to stay small. We're going to show you that. So you're bigger in your A+ setups that are working, smaller in your trade setups that are not working. There are 2 potential exits. Pretty simple. Allow it to expire or put in a good till cancel. We talked about that. figure that you could do 2-cent slippage. So if you sold something for 47 cents, put in a good till cancel that you'll buy it at 2 cents. Believe me, just like you would on the call side, you're going to get filled. I don't know why they fill them, but they do. You're going to give away 2 cents of slippage. And you know what? That's just how it's done. Now you can allow it to expire, and then you don't give up any slippage, but you're having to hold that all the way to expiration. And the difference is, this guy says, well, what happens if on Monday, right towards the end of the day, the bottom falls out of the market and I had a really good trade and now I gave it all back and took a loss? All right, I get it. Doesn't happen very often, but I get it. That's why you might want to do that. For most of us, we just let these things expire and accept the fact that the numbers bear witness to 60% of the time we're going to win, regardless if that happened or it has not happened. Okay. Again, it's not recommended to allow those calls that are short to expire in the money. For the bull calls, just put in a good till cancel order to exit at 98 cents. Okay. So here's the edge. This is a spreadsheet some of you may have seen. I share it quite often. This is a spreadsheet, an Excel spreadsheet that looks back till October of 2009. There's nothing magic about 2009. Just a date I picked. And it said, looking at every 5-day window. So the first one, looking, was a Monday, looking 5 days out. Where was the market 5 days in the future from the first one of these days? Where was it on Tuesday, 5 days in the future? Where was it from Wednesday, 5 days in the future? Where was it from Thursday, 5 days? Okay. There were 3,040 potential 5-day windows since October of 2009. Out of those 3,040, 1,866 were up. In other words, they were higher on day 5 than they were on day 1 for a 61% of the time. Now, some of you are looking and they're scratching your head saying, but Dave, this is every day. This is Monday, Tuesday, Wednesday, Thursday, but I thought Tuesdays and Wednesdays and Thursdays weren't full 5 trading days, and they're not. This is looking at every single day. It's giving you a rough estimate that this is a 61% probability of being a winning trade if you could do a 5-day trade. Because we don't have expirations on every day of the week, you can't. But we're gonna clarify that in just a few minutes. 38% of the time, or a little less than 4 out of every 10, these would have been losing trades if you could do a 5-day trade every day of the week, every single one of the days that we've had since October of 2008. All right, I think it's interesting that your largest up was 17% in 5 days. It was also 17% was the largest move down. So for those of you that think that it's significantly worse to the downside than it is good to the upside, the numbers don't bear that out. Looking at the median, in other words, you take out the highest and the lowest as outliers and you just look at everything inside the bell curve, pretty much the same move up and down. Pretty much same thing if you look at every single one of them, including the outliers, pretty much the same move up and down in a 5-day window. So what about a longer period of time? What if you were to look at 22 days instead of 5 days? Could you do a 22-day version of this? In other words, approximately 30 calendar days. You would be right 69% of the time. Now, that's a lot easier to do a 22-day version of this. It may not be exactly 22, it may be 21, and maybe 23, but you could get pretty much every day an at-the-money trade on And you would have been right 69% of the time. That's edge. If you have a 1-to-1 risk reward and you're right 7 out of 10 times, there's no way over time you can't make money unless you tinker with it, like I did on my naked put. Right? If you don't tinker with it, you can make really good money. Now you may ask, well, why not do this on a 22-day window? Well, because you potentially could have $22 $50 or $2,200 trades on, right? I mean, in theory, every day could be a little higher than the day before, and you could have put on 22 of these. Well, do you have $2,200 or $4,400 or whatever in your account that you can allocate to this? Then fine, do a 22-day version of this. This trade I'm showing you is the bare minimum, simplest, don't have to worry about it. You can put it on as many times as you want. It's the basic trade. If you want to get a longer time frame, in other words, positive drift working in your favor, then by all means, do a 22-day trade. Just understand you're going to be using more money because you're going to have more trades on. All right. As long as you're okay with that and you understand that, that's fine. Okay. So there were 3,025 22-day periods since October of 2009. 2,100 of them were up, 919 were down. 3 out of every 10 were down, 7 out of every 10 were up. That is edge. Any way you look at it, that is edge. You just got to do the trade over and over, exactly the same. All right, so this is my spreadsheet. It's not very pretty. I'm not, I don't make the prettiest spreadsheets, but it isn't intended to be pretty. There are some of you out there that are looking at this saying, Dave, you made way too much work for yourself. Well, perhaps I did, but this is my spreadsheet and it works. What this does is it looks at every day of that we've had. So this goes all the way back to October 5th of 2009, and that was a Monday. The 6th was a Tuesday. The 7th was a Wednesday, so on and so forth, all the way through. So on Monday, if we're going to assume that we put on a trade every Monday, there were 632 potential Mondays. And if Monday was a holiday, then I went to a Tuesday. I don't know if we can see any of those on here. I don't think we can here, but I'll show you one. Anyhow, if it was a Tuesday, first day of the week, then I fixed it so that there was a 1 there. All right. If that was put on and if the following Monday was higher than this Monday, then it was considered a win. So we put $50 there. And we know that anytime it did it, because here's a Monday win column. So if we have a 1 there, that means that this Monday was higher than this Monday. This Monday's close was higher than this Monday's open. That's all that means. So I made $50 on that trade. On Tuesday, if Tuesday was higher on the open than Monday, then there was a 1 there. So yes, we added on a trade. If that was a win, there's a 1 here. So I made $50 on that one. Now, if we look down here, here's a Wednesday, there's a 0, which means Wednesday was not higher than Tuesday. It was not higher than Tuesday. So there was no trade. So there couldn't have been a win. It's a 0 trade. Thursday was not higher than Wednesday. So we didn't put a trade on there. Couldn't be a win or a loss. All right, now let's look. Here's one. This Wednesday was higher than this Tuesday. We know that because we put on a trade, but we lost money on that trade. Same thing with this Tuesday. Tuesday was higher than Monday. So we did put on a trade. It was a losing trade. We won on Monday. Monday turned out that on the following Monday, it was higher on the following Monday close than it was Monday's open. But Tuesday, this wasn't higher than Tuesday's open. It wasn't higher than Wednesday's open. So you're going to see situations where part of the week you won and part of the week you didn't. In other words, this trade doesn't assume that if Mondays was a winner, then Tuesday, Wednesdays, and Thursdays was a winner too. They all stand on their own merit. Some of them won, some of them don't. But you can see here, we got on a total of 5 trades per week. 5. 1, 2, 3, 4, 5. We had 1, 2, 3, 4, 5 winners for a total of $250. We had one contract risking $50. We made $250 across the board on all 5 of those. But let's look down here. I lost $100. How come I didn't lose $250? Because I was only in 2 trades. In other words, this week it wasn't working. So we stayed small in our losing weeks. We were bigger in our winning weeks. That is the key. We're bigger in our winning weeks. And well, here's 2 weeks in a row that were losers. We were smaller in our losing weeks. Do you see how that works? So I'm going to bring over the spreadsheet. I'm going to show you what that looks like. Bear with me one moment. Okay, this is the spreadsheet. 61% of the time, in other words, there were 632 Monday trades. Of the 632, 384 of them were winners. This is Monday's win column right here. 384 for a total of 61% of the time, pretty close to that other spreadsheet that looked at every single day, right? Every single day, about 60 to 61%. Monday to Monday was a winner 61% of the time. Now, in between, there were 1,369 entries. Not all of them were winners. 814 of the 1,369 midweek entries were winners for a 59% win rate. Very similar to that spreadsheet I showed you. All right, so it's roughly about 60% of the time these would have been winners. If you have a risk of $150 and a reward of $150, and you're right 61% of the time, if you just do a Monday trade, and you are right almost that if you do midweeks. Do you see where that's optimized? This is the blackjack table phenomenon where they open more and more tables. You're getting on more and more trades. Now, I looked at a lot of things like, what if the VIX was up? Let's not do a trade if the VIX is up. Or what if we're below the 50-day moving average? The market's bearish. We don't do trades, bullish trades, when the market's bearish. None of that made any difference. In fact, all it did is cut down that number to a much smaller number. So our end result was that we earned less money. In other words, we had less tables, we had less hands being dealt, so we left money on the table. If you had done this trade with just, well, this is looking at 3 contracts. So if I did just one, that changes everything to $50 risk, or $50 reward, $50 risk. I can change that to whatever. I can make that a 10, and now I'm risking $500 and reward of $500. All right, so I can change that all I want. If you were to do, say, 3 contracts, you say, okay, I can risk $150 each trade. Well, how much is that if I did $150 each trade times, and I did a total of 5 trades? Oh, it's about $1,125. If I have a $2,500 account, I can do this. I can do up to 3 of those and only be using $1,125 of my account. So you don't need a super big account. And what would you make with that $1,125? You could have made, now again, this is hypothetical in the sense that you've done every trade exactly perfect. You've executed perfectly, and no one's going to execute perfectly. Mathematically, based on hypothetical conditions, $57,000 over a 12-year period for a trade that takes you no longer than about 10 minutes every day. Super, super easy. If you did one of these, just one contract, how would that do? $20,000 over 12 years. That's a pretty good start for a kid that's just getting started trading the market. You don't have to have any special ideas or technique. And it looks like that is, I think that's your expectancy. No, this is your expectancy. Every time you put on the trade, you can expect to make $30. Every time. Win or lose, if you lose money, don't worry about it. You're expecting to make $30 every week if you do one contract. If you do 3 contracts 3 on Monday, 3 on Tuesday, 3 on Wednesday, $100 for the week. You could be your expectancy. Now, I'm going to show you something pretty cool. So how is Tuesday, all the Tuesday trades that won or lost? On Tuesday, it has a 60% win-loss record. Okay, what about Wednesday? Let's change this to Wednesday. About the same, slightly less, 209. What was that on Tuesday? 195. So in other words, there were less opportunities. We put on less trades on Tuesday because it was not a favorable day. And we can prove that. There's 325. Let's make this Wednesday. There were 350 trades. So that's why that number's bigger. So 350 potential trades. Let's look at Thursday. 59%. Let's look at Friday. Oops. 57%. So Friday, understandably, would be the worst day, right? Because there's only Fridays open till Monday's close. There's only 2 days for this to be profitable. It's less days than Mondays. So it makes sense that Fridays would be the worst day. But does that mean you don't put a trade on Friday? No, because it's right. You're right almost 60% of the time. Why wouldn't you put that trade on? Yes, you're going to have more losing trades on a Friday. Okay. You're going to have more winning trades than you are losing trades. And if your risk reward is 1-to-1, who cares? Get that number up as high as you can get. So you can see this number got to about 2000. I think it's 2001, actually. Somehow that's missing one. I don't know how. It's missing one somewhere. But 1,369 plus 632 is 2001. You want to put on as many trades as you possibly can because the edge is in your favor as long as you do the 1-to-1 risk reward. If you want to do a 30-day trade, do a 30-day trade. Just understand you have more money. You have a lot more money that you have to have allocated to this in order to do that trade. But you're going to make more money overall. All right. Let's see what else we have on that. I don't think. Let me take this down. Hello. Okay. All right. We're going to show you how to determine if you have edge. Now, you can do this on your own. I'm going to show you a feature in TOS. There's a couple of things that, there's a couple of beakers on here. I'm only seeing one. There's another one over here somewhere. If you click on that beaker, it brings up a dialog box that is an edit for studies and strategies. This is a strategy right here. It's just a default strategy. I just picked the first one. All right. And what it says is that if you had done this trade, this is actually supposed to say 180 days. If you'd have done 100 over the last 180 days, if you had done this strategy perfectly, every single time there was a buy signal, you would be up $4,600. You, at the end of 180 days, might say, I'm a genius. You know, I've found the Holy Grail. Well, perhaps. If you go put your mouse right on any one of these highlighted hyperlink bars here, right on wherever the writing is, right mouse click, and you can pick up what's called it's a show reports. Well, this is the report, and you can export that to Excel. And it said that the biggest win was $689. Yeehaw. And overall, you made $4,616, and you did 466 trades. What this doesn't tell you is how many of these were wins and how many were losses. So I put in a formula out here that says if this number was a negative number, put a 0. So that was the P&L for this particular trade. Lost $18. This one made 44. This made 124. This one lost $28, so on. So if it was a loser, it's a 0. If it's a winner, it's a 1. I tallied all the winners, 181 winners out of 466 total trades. That's the number of total trades. Guess what? 39% win-loss record. What's really scary is that there is no risk-reward equation here. I mean, the exit is based on some phase of the moon, right? Some crossover average change in the stars, something that says, oh, get out. You have no way of knowing when you enter that trade what your risk and what your reward is. You have no way of knowing. It just is when it says get out. One time that could be a $5 win. The next time it could be a 50-cent win. You don't know when you enter that trade. I'm telling you, if you're only right 39% of the time, over the long haul, over more than 180 days, let's say did this over 12 years, this is not going to be a profitable trade. The only reason it is profitable is because of positive drift. That is the only reason it is profitable. There is nothing magic about this. I'm not bagging on ADX. It's a good indicator. I use it for some things, but it is not the holy grail. I have an indicator and I call it the super secrets. Yeehaw. Okay, that's really mysterious. All right. The difference is it does have a finite risk reward. My profit target is 1/3 of 1% move. My profit stop loss, I should say, my stop loss is 1/3 of 1%. So from the time we enter to the time we get out, that move down was 1/3 of 1%. And to get in and make a profit, it had to have gone up 1/3 of 1%. That is defined risk reward. It's not going to be any different from the entry to the stop loss as it is from entry to the profit target. It's the same equation. I was up $10,394. That's somewhat better than 4,000. However, let's take a look at the report. Same thing, biggest win was comparable to what the ADX was. Total P&L was 2.5 times bigger. Few less trades. I think the ADX was 466, if I remember correctly. So again, we have 433 total trades. 225 were winners. That's a lot more than that ADX. In other words, 52% of the times. And I have defined a risk reward over time. I don't care whether that's 100 days or 500 days. That is a winning edge strategy. If you have that, you can find that in strategies. You have to go into strategies. You have to look for the one that you like or custom build your own, but you can determine whether you have edge in your day trading by using strategies. All right, so we're just going to go over this and summarize everything. You enter this as a $1 wide bull put. I don't recommend legging in. Don't be Dave. Remember that. Don't try to go naked on one side and then add in the other side later to get better than 50 cents. Just be happy that you have the edge. Don't try to be cute. You're trying to get somewhere between 47 and 50 cents of either credit or potential credit if you do the debit side. If at least 47 cents is not available, try and move your strikes up one strike to try to get that one-to-one risk reward. Don't go any more than that. Don't chase it. Okay, dollar wide at 50-cent credit means you're risking $50 to make $50. If Tuesday the open is not greater than Monday, then don't add on the trade. Same for Wednesday, Thursday, Friday. If Tuesday is higher than Monday, add on. If Wednesday is higher than Tuesday and so on, go ahead and add on. All right, that is the trade. If you have questions, please feel free to reach out to me. You can reach me at the Yahoo email address. If you want to join our group, go ahead. Nobody's going to sell you anything. It's free. We talk about trading. If you have questions, there's a lot of very good traders in there that would be happy to help you. Just leave your political comments and agendas outside, or we will politely escort you to the door. That's not what this is. There are a lot of groups that you can do that. This is not that. This is for traders and trading talk and opportunities. This is not your forum to sell your latest and greatest indicator. We will remove you. All right, that's it. If you have questions, reach out. Again, thank you for taking the time to stop in and listen to me rant and rave. I hope for you nothing but the best of trades. Always seek out risk and reward and edge in all of your tradings. And as always, good trades.